Welcome to In the Money with Mr. Darson. I am Mr. Darson, and it is my pleasure to speak with you today on the topic of investments. Today, we'll be talking investing basics. We'll go over some investment concepts, some tools, some investment vehicles, and also show you how to establish your investment account. Before we do that, take a moment, hit the like button, and don't forget to subscribe. The journey of 1,000 miles begins with the first step. When it comes to investing, the key, the first thing that should come to mind is the idea that you need to be saving money. Investing allows you to put that savings to work. But if you're not saving, you don't have a consistent income source to utilize to go into your investing plan. I can't emphasize enough how important a plan is. A plan gives you something that's so key, and that is consistency. Use a plan to make sure you're allocating funds each pay period, each month, or however frequently you decide, in order to add monies to your savings account. That account will be the source that's utilized to fund your investments. When it comes to opening an account, you have a number of sources. Those sources typically include banks and credit unions. However, in my experience, if your plan is to be an investor, those two options may not provide your best source for getting money in the market. I prefer the brokerage account option. So, using Wall Street to get your money on Wall Street. Let's talk about some of those brokerage account options. There's a number of firms I could include, but here I'll list three. First, there's Fidelity. I like Fidelity because, as an overall broker, it's a great source. There's lots of information, it's easy to use, and is extremely low cost. Secondly, there's TD Ameritrade. TD Ameritrade is great for beginners. It has a ton of resources to introduce you to investment terminology and help with the learning process. And it also has a very great mobile platform that I really like. I'm also including Tastyworks. Tastyworks, unlike Fidelity and TD Ameritrade's Thinkorswim platform, is a little bit less known, so it goes under the radar. But for the more advanced trader who wants to specialize in options, Tastyworks cannot be surpassed. It's fairly easy to deposit money into your brokerage account. Most brokerage firms, like the ones I mentioned, offer a cash management account that allows you to deposit your paycheck, Social Security, or the pension benefits directly into the brokerage account. All you need to do is provide the broker's routing number and account number to your employer or third party, and then they will be able to deposit money into your brokerage account. Funds received by brokerage firms will typically be deposited into something called a cash management account. A cash management account is a cash account offered by financial institutions other than banks or credit unions, designed for managing cash, making payments, and they even earn interest. The idea of a brokerage account is to be able to invest your money for the future. So you'll want to have as many options available to you as possible beyond just an interest bearing account. And with the brokerage accounts we mentioned, there are a number of different investment paths you can take. The most common include mutual funds, individual stocks, bonds, and a great tool known as an ETF or an exchange traded fund. Let's start by talking about bonds and exactly what bonds are. A bond is a debt security similar to an IOU. A borrower issues bonds to raise money from investors who are willing to pay the borrower or lend them money for a certain period of time. When you buy a bond, you are lending the issuer of the bond money. Now, the issuer could be a government, a municipality that's local, or a corporation. In return for the money that you lend, the issuer promises to pay you a specified rate of interest during the life of the bond and repay the principal. That principal is known as a face value or par value of the bond. The primary reason investors buy bonds is to earn income. They want a dependable income stream that pays them out periodically over time. If bonds are held to maturity, those bondholders get back the entire principal, making bonds a great way to preserve capital while earning interest. Bonds tend to be less volatile than stocks, making them less risky of an investment. Now let's talk about stocks. A stock is also called an equity, and it is a security that represents ownership or a fraction of an issuing corporation. Units of stocks are called shares. Shares entitles an owner to a proportion of a corporation's assets and profits equal to how much they own. Companies that are publicly traded have issued stock to raise funds to operate their business, and the holder of the stock, called a shareholder, has a claim to part of the company's assets in proportion to the percentage of the stock that they own. There are two main types of stock, preferred and common stock. And a thing to know about stocks is that historically, they've outperformed other investments in the long run. Now, let's focus on mutual funds. A mutual fund is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and short-term debt. Now, the mutual fund will typically have an investment objective that is trying to achieve. The combined holdings of the mutual fund are known as its portfolio. The main reason why investors buy mutual funds is because of what they offer. They provide professional management by fund managers that do research for the investor and select securities to build the mutual fund portfolio. In doing this, mutual funds typically have built-in diversification. Uh, you don't have all of your eggs in one stock in a mutual fund. There's a pool or basket of stocks that creates an individual mutual fund. Mutual funds also offer affordability in that they can be purchased at a relatively low dollar amount, and you can dollar cost average your way into mutual fund positions. They're also relatively liquid. Mutual fund investors can easily redeem their shares on any day the market closes at the current net asset value, plus any redemption fees. An ETF is a tool that's similar in many ways to a mutual fund, but it also has some characteristics that are unique to stocks. What an ETF offers investors is a way to pool their money in a fund that makes investments in stocks, bonds, or other assets. And in return, they'll get a payout on an interest rate. Unlike mutual funds, however, they can be traded on a stock exchange throughout the day. That intraday trading feature allows ETFs, exchange traded funds, to be traded throughout the day without having to wait until the market closes to redeem or sell your ownership shares in that particular investment. In describing an ETF, I've often heard it termed as the love child or offspring of stocks and mutual funds, as it embodies some of the best features that each has to offer. So far, we've covered the importance of savings and where you can set up an account to direct your savings to get started with investments. I use the word get started because that's exactly what we're doing. We are just getting started. I encourage you to stick around and continue to log on and watch videos so that we can add to your arsenal of tools to help you grow your wealth. Before you leave, remember to do us a big favor and hit the like button and subscribe to In the Money with Mr. Darston.